So what's more important, getting the forecast right or getting the cost of capital right? This could be an interview question. What's more important, getting the cost of capital right or getting the forecast right? The forecast 100 times, all right? Most mistakes are not made on the cost of capital. If you lose money in an investment, private equity, venture capital, public market, and private equity investing, it's not your cost of capital was off by 20 basis points. Is that your financial forecast? You misassessed the company's business prospects, all right? So yes, there is some cost of capital. I shouldn't dismiss it, but in the scheme of things, it's not that big of a deal. Most companies' cost of capital is anywhere from 8 to 12%, and there's probably you're not going to, get this wrong. But to me, there's way too much academia focus on this topic, which in the scheme of things doesn't move the needle. So this is a cartoon I find, right? Go away. Exactly, right? So this is my view. So now to be serious, right? Cost of capital. So when we do a DCF, which we'll get to, right? The numerator is our cash flow fork. The denominator is the cost of capital, right? And, as Nicholas said in the email, there are questions if you're interviewing about cost of capital, but there is some degree of importance. I hate to dismiss it, but in the scheme of things, it's probably at the lowest thing that I care about, right? Everything, right, when we are valuing with taking a cash-generating asset, you are using a DCF model. Whether you're in VC, private equity, and the analysis is the same. This is, by the way, and I'm going to get on my high horse, this is what kills me about not just this school, but all business schools. We got venture capital, we got private equity, we got my class, equity securities, and we got investment banking. It's all the same shit, right? We are taking cash flows and projecting them into the future and discounting them back to today, right? This is in essence what finance is all about, right? And, and we're going to, you guys have projected the financial statements, and, you can probably already have enough data to do the free cash flow generation. Now, right, we need to calculate the discount rate, right? So the first part, which we have done, is estimating the cash flows, right? The next part is what is the appropriate discount rate or cost of capital, right? And the cost of capital needs to reflect expected return and risk associated with the investment, right, being considered. So, we are trying to come up with an appropriate cost of capital that measures the, risk that's associated with it, right? Now, the good thing is that we can look to the financial markets, right? The capital markets basically tell us what it is, right? And I think this is why many in finance love cost of capital is the capital markets basically inform us as to what the appropriate cost of capital is. I would argue there's some dangers inherent in that, but this is why it's loved by academics, right? So what are some risks, right? If the cost of capital is too high, if we jack it up to 2020, we're going to miss a lot of opportunities, right? Our assessment of risk is too high, but conversely, if we set it too low, we're not really incorporating the riskiness of the investment, and we're going to lose money on the investment or the project we're pursuing because, we didn't really assess how risky this project or this investment we're looking at it is, right? So there are two components to the cost of capital, the equity cost of capital and the debt cost of capital, right? Based on the weighting of debt and equity on a company's balance sheet, you can estimate the total cost of capital. The cost of capital is easy. It's the rate of interest that you can borrow at. The equity cost of capital, it's not like it's rocket science, but it's a bit more complex. And we're going to, spend, right? And the equity cost of capital, importantly, is much more expensive than the debt cost of capital, right? Equity is much more expensive than debt, right? Why do you think that is? Well, debt, right, has a fixed coupon. We know exactly what the coupons are, and they are senior in terms of the claims of when everyone's going to get paid. And so because the variability of the cash flows is, it's set, it's much less, right? And debt holders get paid first. Equity, right, because With the coupons, what we are going to get it's very uncertain. And in fact, if you look at the stock market every day in terms of how company stocks trade, people are making assessments on what those future cash flows are on the equity side. Secondly, because equity holders get paid last, right? We are further down on the cash flow waterfall, and again, that results in the riskiness. So debt or equity, right, is much more expensive than debt is. So if we go back over time, you can kind of see stock returns by decade. The last 10, 15 years has been pretty great on the equity side, right? The excess return, well, it's the difference between the average realized return on an investment and the average realized return on a risk-free security. Investors are risk averse. We demand to be compensated for risk. Excess returns are higher with increased risk, right? The higher the perceived risk of an investment, the greater the expected return. And our compensation for risk is defined as the risk premium. We always compare it to the risk-free rate. So for purposes of this, the risk-free rate is the 10-year Treasury, right? The 10-year U.S. Treasury is really our risk-free rate. What happens to expected return for any investment as the risk-free rate increases? It goes up, right? So if that bogey, which is the 10-year, right, we expect a premium. So this is why stocks typically fall when rates rise, right? So if the 10-year was 2%, and we expect a risk premium, call it 3% on top of that, our cost of capital on the equity side is called 5%. But now if the 10-year goes from 2% to 4%, and we demand still that 300 basis point premium, right? Now our cost of capital is 7. As cost of capital rises, the NPV of the future cash flows decline. So it's important to understand that the returns and the risk-free rate to some extent are directly correlated, right? So small stocks, right, tend to have average excess returns versus Treasury bills or corporate bonds, or for that matter, the S&P 500. So I was listening to this podcast last week, and I was listening to this guy, Howard Marks, speak. It was pretty funny, and he was making fun of this very chart that we all use. He basically says, if everyone knows the excess return is so high, then how are small stocks so risky? I thought that was a great point, right? If it's so risky, then why is the return so high? In fact, you can argue the risk of small stocks should be low if this is what the return profile is over time. But anyway, so if we plot return on one axis and volatility or standard deviation, and you can see, right, as we go from risk-free, right, to small stocks, right, there is an increase in volatility as we move up the curve, right? Systematic, who here is taking core currently? You all should be experts. And was there a question in the midterm, or did you guys go over systematic risk, or are you currently, is this a second half or a first half?
Yeah, just went over it.
Oh, so this is on the final. So you guys did, all right, because I taught core. They switched it around the last couple of years, right? So systematic risk is the risk inherent to the entire market that affects all securities. We also refer to this common risk or undiversifiable risk. Idiosyncratic risk is company-specific that affects a particular firm. Other is independent, unsystematic, right? Diversifiable risk, firm-specific risk. So if we think about what systematic risk is, to me, and this is what we'll get to in a beta, systematic risk, if we look at what is the one thing that affects all stocks but affects all companies differently, is the economy. So when you see systematic risk, it's really how economically sensitive is this company I'm looking at versus that of the overall market. Idiosyncratic or firms, this has to do with the individual company, right? The launch of the new iPhone, 16 or whatever it is, right? Or, a new product that's being launched, by a company, right? This is, specific, or a new software release, et cetera. This is specific to the, to the company. So diversification, right, is the process of averaging out idiosyncratic risk in a large portfolio, right? When we average this with many stocks in a large portfolio, specific risks for each stock are averaged out and diversified away. However, we cannot diversify systematic risk out, right? By the way, this may be, how many stocks do you actually need to get to before you get the law of diminishing returns, where systematic risk, if you add an additional security, the effects of diversification go down? It's actually 25. So once you get past 25, as you add an additional security, the benefits of diversification actually is actually less, right? As you increase the number of stocks, idiosyncratic declines. With diversification comes lower volatility. However, again, there's a lot of diminishing returns as the number of stocks in the portfolio increases. So we measure, right, the risk premium, or we really look at the market portfolio as or the S&P 500 as the overall market portfolio or market risk. So the S&P 500 is really what we are looking at, when we measure, systematic risk. What is the overall, riskiness of the market portfolio? And it's, efficient portfolio. But usually, again, it is the S&P is used as a proxy for the market portfolio. The market portfolio has no idiosyncratic risk embedded in it, right? The only risk that is embedded in the market portfolio of the S&P 500 is systematic risk, right? Beta, right, is a measure of systematic risk of a security relative to the market as a whole. So if if a beta is greater than 1, it says it's going to move more than the market. If it's going to move less than 1, it's the security moves less than the market, right? And so, and greater than 1, it means has more systematic risk, less than 1, less systematic risk, and equal to 1, it's basically the same as the market. So what is beta? What does beta measure? Beta really measures the systematic risk of a company, right? But what does this mean? It really, how economically sensitive is this company, right, versus that of the S&P 500? Beta really measures the economics, how sensitive is this company, business, overall business, with changes in the economy. So here, like two extremes, right? American Airlines has a beta of 1.82, Coke has a beta of 0.6, right? Coke obviously is much less economically sensitive than that of American Airlines. And you basically, and for that matter, the market portfolio, you need to, people drink Coke irrespective of how, weak or strong the economy is. People's use or air travel is very economically sensitive. If things are tough economic conditions, they are going to travel much less. In a strong economy, right, business travel goes up a fair amount. There's a lot of activity going on, right? It's really the perceived riskiness of the company and its business model versus the market overall, right? So if we look at the S&P 500, right, it has a beta of 1 by definition, right? Its systematic risk is equal to 1. It moves, directly with the economy. So how is beta measured, importantly? It's the daily price movements relative to the stock market as a whole. So what's going on here? Beta is determined by a time series, right? So you're going to go back 10 years, and you're going to have a monthly listing of month-end stock prices of, call it Google, and you're going to compare how did Google's stock move relative to that of the overall market, right? What is the daily price movements of Google or Amazon, for that matter, versus the S&P 500? You were going to run a regression, and this is essentially beta, right? So what does this mean? Well, basically, the big assumption is that we are basically equating daily price movements with risk. So what we were saying is if we do a time series going back a number of years, we are saying that the more volatile our company is relative to that of the market, the more risky that company's business model is relative to that of the market, or less risky, right? So in Coke's case, its stock price moves much less than the overall market did, right? So what we are saying is investors are saying this company is less economically sensitive. We measure economic sensitivity by how much its stock price moved. Whereas American Airlines, when the stock market goes up or down, its stock goes up and down much more than the market does. This basically what we are saying here is that American Airlines, because the stock moves much more, the investors, are assigning more risk to it. That means it has more economic sensitivity. Right? So this is beta. And so, right, I'm sure you've all seen the capital asset pricing model, right? So the expected return of a stock is the risk-free rate, the 10-year, plus the beta of the security, the return on the market, less the risk-free rate, right? The only security-specific component of this formula is the beta. For every other company, right, the R sub M, the return on the market, and the risk-free rate, it's essentially the same, right? So really, it is the beta that's going to drive the expected return. So the lower the beta, right, the less risky this company's business model is perceived by investors. The lower the expected return, the higher the risk, the higher the expected return, right? Risk is compensated by beta times the return on the market less the risk-free rate. And with a market, and R sub M minus R sub F is the market risk premium. We are compensated for risk by the amount of systematic risk we are taking times the market risk premium. And so what this says, right, as we are willing to take on more risk, our expected return should increase. This measures here, right, the market portfolio of the S&P 500. It is a beta of 1. As we go to the right, our beta increases, and with that should be our expected return. And so alpha, and God, I mean, when I start to see Greek letters, my head turns upside down. I don't really, So what does alpha, represent? Well, we're going to look at what was the actual return on the market, what was the actual return on the security, and then what did the CAPM tell us to be, right? This is in essence what it does. Alpha is the difference, right? So if the capital asset pricing model tells us it should be here, but the actual return is here, this difference is what we refer to as alpha, right? And so many times, you hear alpha being discussed amongst stock pickers. How much alpha did the fund manager add? This difference is really a function of stock picking, right? We were able to generate significant alpha. The CAPM said it should earn this, it earned this, right? Conversely, if it's below the security market line, the CAPM said it should be here, but it only was here, right? And so if we shorted the stock, we basically figured this out, that the stock would earn less than what the CAPM model told us, right? So again, the difference between the market return and the risk-free rate is defined by this. Key determinant when estimating the required equity return, this is the market risk premium. Interestingly, it changes over time based on investors' expectation of risk. So again, this is referred to as the market risk premium or the equity risk premium, the ERP. So what drives this, if you actually go back over time, this equity risk premium or market risk premium is going to change. And it's going to change based on the degree of risk aversion, right? Economic risk perception of investors, inflation uncertainty, and liquidity, right? These are all things that essentially drive R sub M minus R sub F. And it actually changes over time. So there's this guy, Aswath Damodaran, who's an NYU professor in finance, very well known, very well published. A lot of the academics at BU, and for that matter, academics overall, like to throw make fun of him all the time, but this is what he actually has figured out a way to calculate this. And essentially what he does, it was like an 80-page paper, which I'm embarrassed to say I read most of, is basically he figures out what the expected earnings for the S&P 500 are, and then he sees where the price is for the market, where the market is trading, and then he figures out what is embedded in investor expectations. So if we go back over time, R sub M minus R sub F, this is what we see here, right? And so there's a relationship, right, between valuation and what this equity risk premium is, right? At the end of 22, when the market had gotten killed, right, there was, when there was risk or there was fear in the markets, the equity risk premium moved up a fair amount, right? Now, today, I would argue the equity risk premium is probably 4%. And so for all my classes this semester, we're using a return on the market of 8 and a risk-free rate of 4. Right, so I would argue it's today we're at a low, and that actually, when you think about it, makes sense, right? The market has an all-time high, valuations are somewhat stretched, and so, right, the equity risk premium has narrowed a fair amount. If we go back to these factors here, right, there's very little economic risk being priced in. We're not really concerned about inflation anymore. There's a ton of liquidity. And investors are basically throwing money at any asset class because they're looking for higher returns, right? So this is really what is going on today. Now, there is a relationship between the risk-free rate and the return on the market. It isn't one for one, right? As the risk-free rate increases, it makes sense, right, that the return on the market should increase as well, right? So if the risk-free rate is 4%, the return on the market should reflect that 4%, because we as investors, if we're going to buy the S&P 500 index, we demand a higher return versus the 4%. This is going to change. Well, let's say the risk-free rate is 2%, right? We're going to demand, even if we demand the same premium, right, the overall return on the market is going to reflect that 2%. So there is a relationship between the risk-free rate and the return on the market. It isn't one for one, but there is some. There is a relationship. And here we can see, how this has changed over time. And I think today we're probably at the, probably at the 4% level, right? So that is the theory. Here are some issues, though, if we step back and think big picture, right? As the equity risk premium declines, valuations increase, right? So now I'm putting my fundamental investor hat on, right? So you would argue, right, if there's a lot of investor optimism, and this is reflected in valuation, we should be concerned, right, as fundamental investors, right? Results in valuations that are high by historical standards. You would think at the high valuation, you would probably want to, have some margin of safety and actually demand a higher return, but yet we're demanding a lower return. It's actually asked backwards, right? We are introducing valuation risk, right? And so this is, how does this play into financial decision making? This is where it kind of gets hard, but this is the pure theory, which you should know. But if we step back and think about this as fundamental investors, right, today, right, there should be warning signs, right? The market's at an all-time high, valuations are high, but now we should, as that market risk premium shrinks, valuations increase as a result, right? So, and just on this point, so Warren Buffett actually does not believe in this beta bullshit, right? He's like, that's for the birds. He actually, when he does a DCF in his brain, because he's brilliant, he uses the 10-year treasury. And his point is, he's going to, look at in company A versus company B, whether public or private, and he's going to think or, forecast the cash flows out in his head and arrive at what he thinks the equity value is today. his point is that I know the riskiness of this business much better than any investor or the market is telling me. So he poo-poos this whole beta thing and basically says, I, Warren Buffett, know the riskiness of this investment better than anyone. I'm not going to let the market tell me what this, the riskiness is. I'm going to do it. So he uses the 10-year. I have a friend who runs a very successful hedge fund in Boston. He doesn't do any of this. His minimum threshold is 13%. So or 13 or 14%. That is their cost of capital. It has not changed since he started his hedge fund in 1990. And if we think about what's going on here, that actually makes a lot of sense, right? Why are you going to let what you're willing to pay for this company be influenced by rates and investor perception of risk? 13% is my threshold, right? And that doesn't change. The danger you have, right, is as rates go down and valuations increase, and you're basically using a low 10-year, to arrive at what you think the company's worth. What happens if the 10-year goes from 2% to 5%? This is what happened in 2022, right? The Fed 2021 or end of 2020, 21, we had insane valuations. And then the Fed started to raise rates. What did the market do in 22? It got crushed, right? So the market reflects interest, the 10-year, and all this stuff, in that previous slide. And so you can argue, how smart is it to use this equity risk premium thing? Because if the risk-free rate, or the CAPM, if the risk-free rate changes, you're going to be chasing your tail as the market corrects. So the risk-free rate, as I discussed, kind of critical. Here's the risk-free rate over time. When I was teaching corporate finance, back here, I said the big question is, where are rates going to, normal? Is 2% the new norm? And I would argue, I think 4% is really where the 10-year, and that's basically where we are today. So this is why the market went so ballistic, and actually why the last 15 years has been so great. We've had just a big decline in rates, and 2022 is really about the normalization of rates back to, where they should be historically, right? And the most important item over time in valuation is obviously interest rates. If interest rates are destined to be at a very low levels, it makes any stream of earnings worth more money. Why is it that in 2020, 2021, that the companies that had the highest growth rate were valued the highest? And why is it at 22 when, even though the growth rates didn't change, those stocks were penalized the most? Well, if we were to look at how we value these high growth stocks, we need to go out 10 years, right? And we need to use a DCF, right? The terminal value. Well, if that terminal value is 10 years out in the future, and we're using a discount rate that's low based upon where interest rates are, the value of that's going to go up a lot. What happened in 22 is 10 years out, now that risk-free rate is increased, right? The value and the company is basically driven, especially high growth stock, off of that terminal value. If that terminal value now is being discounted back today at a much higher level of interest rate, the value of the equity is worth a lot less. So this a couple of quotes. The bogey is always what the government bond yield. You can pick your maturity. As you see in real estate yields adapt quickly and fairly directly with rates. It's the same with stocks. Any investment is worth all the cash you're going to get out of it between now and Judgment Day, discounted back. The discounting back is affected by whether you choose interest rates like those of Japan or interest rates like we had in '82. The value of every business, the value of a farm, an apartment house, or any other economic asset is 100% sensitive to rates. That's because all you're doing when you're investing is transferring money to someone now in exchange for a stream of money which you expect to come back in the future. And the higher interest rates are, the less the present value will be, right? Interest rates are to asset prices sort of like gravity to an apple. This is a great quote, right? When interest rates are low, there is little gravitational pull on asset prices. Interest rates power everything in the economic universe. So this is why Fed policy, right, and why the market keys off of Fed policy. If the 10-year is kind of our risk-free rate, and we are adding a premium or risk premium to that risk-free rate, as that risk-free rate increases or decreases, it's going to have a huge impact on our cost of capital. So if we look at the risk-free rate, there's really two main drivers: supply and demand for credit and inflation, right? And the risk-free rate is really the real rate times the inflation rate, if we really think about it. And the shape of the yield curve gives us clues about the market's views about future economic activity. So I believe, and so this is where we were back at the end of 20 and 21, the Fed aggressively raised rates, and now we're basically back to, call it 2.5, 2.6%. But this is why the Fed raised rates so much in 2021, 2022, right? You could totally get a question about this if you're interviewing, right? Three types of yield curve shapes: upward sloping, flat, and inverted. We subtract the 10-year from short-term rates, and this reflects the market's expectation about future economic activity. Most yield curves are upward sloping, meaning that the short rates are much lower than higher rates. And the reason is there's an expectation, right, the economy is going to stay strong. An inverted curve, what this means is that short rates are actually much higher than lower rates. The expectation is the Fed is going to have to, well, two things. The Fed's going to have to dramatically cut, and that rates are actually low because there's an expectation that economic activity is going to be much less. If we actually look at the inverted yield curve, going back over time, has been pretty good about predicting future economic activity. And if we look at it today, there's a concern, right, that the economy is going to slow dramatically or actually cause a recession. So just to summarize the what would Buffett say about this, right? I mean, my hero. So if we look at, the capital, fundamental analysis, as an fundamental analyst, we define risk as paying more for a business than it's actually worth, not its daily price movements. So if we look at how we are truly measuring risk, it's off of daily price movements of the security versus that of the market. This is how we are defining risk, right? If there's a sharp reduction in the price of a business, right, it's probably going to have a much higher beta but a higher risk. But if we look at this from a fundamental analysis, our risk of overpaying now has been substantially reduced. Other issues: what happens if the market's perception of the riskiness of the business is wrong, right? The collective wisdom of the crowd is wrong, and we are equating potential return with price volatility. We need to take on more risk for a higher potential return. This is actually the exact opposite of what fundamental investors actually do. So what does this say about the relationship between the risk-free rate and returns? Well, as the risk-free rate increases, our required rate of return increases with it, which causes the cash flows to be worth less, right? Conversely, if the risk-free rate declines, our required rate of return declines, which means the cash flows are worth more, right? All right, so that's quickly the capital asset pricing model. Now, just on beta, and I was going to exclude this, but I figured I should talk about it because you could get a question about this. So there's something called, if we look at betas today, and the way you determine a beta for a securities, you can go on Google, type beta, whatever, for the stock, and you can, you'll get a couple of searches. What I like to do when I determine the beta for a security is I go to a couple of different sources. Most of them are pretty close, but sometimes you'll get an outlier. That beta reflects the company's capital structure, how much debt is actually on the company's balance sheet, right? And so it actually makes sense, right? The more debt the company has, the more levered its returns are. And if we're getting higher returns, we should get paid more. And that's reflected in the beta of the security, right? Market reflects the degree of leverage in a security by its beta and daily price. Levered beta is the beta that contains the effective capital structure, right? The beta that we calculate above is its levered beta. unlevered beta is the beta after removing the effects of capital structure, right? The more leverage, the more risk to the equity holders. So if we really want to look at unlevered beta, we need to strip out leverage and determine the unlevered beta. So you're like, well, why would I do this? Well, what happens if you're in private equity or venture capital and you're trying to determine the cost of capital for your company and it's not publicly traded? What you would do is look at 4, 5, 6, 3 to 6 different companies in the industry, get their published beta, and then strip out the impact of leverage, right? And then get the unlevered beta for the industry, to get that unlevered beta and put it into a model or calculation that reflects the company's degree of capital structure in it, and this will get you a beta for a private company, right? And this is helpful for valuing companies that aren't publicly traded. So this is the formula, which I'm not going to go over too much detail. The unlevered beta is the levered beta, which you look up, divided by 1 plus 1 minus the tax rate times debt over the market value of equity. So we always use the market value of equity, right? This will get us the unlevered beta. This equation strips out the effects of leverage. And if we want to now take the unlevered beta for the industry, we're going to take the unlevered beta, which we calculated from the industry average, 1 plus 1 minus the tax rate, D over E, the amount of net debt divided by the market value of equity. Under today's lecture, I actually published a spreadsheet. It actually did this for the household products industry. Let's see if I can find one that is. Most of these, as you can see, did not really move. I mean, Kimberly-Clark went from 0.44 to 3.9. Colgate went from 0.62 to 0.58. P&G went from, these companies aren't terribly levered, right? Clorox went from 0.2 to 0.18. But what we do is we take the unlevered beta for the industry, right, which I did here, put it into that calculation, that formula, and then we can derive and observe levered beta from the industry comps. And so you can see here it barely moved. Okay, so if you're interested in how to calculate this, this is under household products. And it's under household products beta, and it's under today's lecture. But again, the importance to note is that beta reflects the company's current capital structure. Okay, that may come up in an interview question. By calculating, an unlevered beta, remove the effects of leverage. We can use to compute the cost of equity capital for private companies using public company comps. Once calculated, we adjusted the unlevered beta for the leverage of the company in question. All right, so that is really, the equity cost of capital. It's by far the most, there's some work associated with it. However, companies have equity and they have debt, and we need to estimate both to arrive at the overall cost of capital. Our cost of capital should reflect both the debt cost of capital and the equity cost of capital, right? One measure which we look at is the yield to maturity, right? So really the yield to maturity on a long-dated bond, 10 years and greater, really reflects two things, right? The, where the debt was issued at from an interest rate perspective, and secondly, investors' perception of the creditworthiness of the company. This is measured in the yield to maturity, right? And so we can access, if you were doing this for a living, you would go to a Bloomberg terminal and look up the yield to maturity for the companies in question, long-dated bonds, right? If there is little risk, the probability of default is negligible, and the yield to maturity is a reasonable estimate of debt holders' expected rate of return. Now, there are some instances where the yield to maturity is way greater than what you're going to actually get. Like if a company was near bankruptcy and its yield to maturity was 50%, you're not going to use this, right? But you probably aren't interested in the company anyway. But again, we look to the yield to maturity as essentially what the capital markets are telling, is this company's cost of debt. We do not look at the interest rate of, where the, when the company's debt was issued, because that doesn't reflect today's interest rate environment, right? We need to, yield to maturity needs to reflect today's interest rate environment, which is reflected in the yield to maturity, right? And again, the other issue is that when the bond was issued or the debt was issued, right, the company's creditworthiness may have gotten better or may have gotten worse. These are both reflected in the yield to maturity, right? Reflects the market's perceived view of the company's creditworthiness, right? Now, if you don't really have it, you would look, a company's private, you try to estimate what the company would actually pay a bank if there was no data like this. Now, you guys are all students. I don't expect you to look this up on Bloomberg. What I do for my classes, I basically, say I'm not going to beat you with the broom. So use 5.5% as your yield to maturity. I think that's a pretty good proxy, right, for most corporations today. If the 10 years at 4, you probably get another 100, 150 basis points of risk premium versus the 10-year, right? Importantly, we always tax effect, right, the debt financing. So first we arrive at the yield to maturity, and then we multiply this by 1 minus a company's tax rate to get, right, the effective cost of debt, right? Because interest is tax deductible, we need the true cost is 1 minus t times the cost of yield to maturity, right? So we use CAPM to compute the equity cost of capital, yield to maturity, or cost of bank debt to current bank debt to compute the debt cost and then tax affect it. So this is, so now we've got our equity cost of capital by the CAPM, and we get the yield to maturity, and then we calculate the ratio of net debt to the company's enterprise value and the equity, the market value of equity to the or total capitalization, and we take our debt weighting times the after-tax cost of debt plus the equity weighting times the cost of equity to arrive at our weighted average cost of capital, right? When we're calculating net debt, we always net short-term and long-term against cash and short-term investments, right? We need to recognize the ability of companies to use their cash holdings to pay down debt. It is a better reflection of the actual amount of debt outstanding. Net debt reflects total debt less cash and short-term investments. So a simple example, we have cash of $1 billion, short-term of 500, debt of $1 billion, long-term debt of $4 billion. How much net debt does the company have? We're going to have $5 billion less 1.5. So $3.5 billion, right? We're subtracting cash and related against total debt to arrive at the net debt of $3.5 billion, right? For the equity value, again, we are always looking at the market value of equity. The book value of equity is a meaningless number. We always look to the publicly traded stock price, get the number of shares outstanding, multiply shares outstanding by the share price to arrive at the equity market cap. So here, a company with $40 stock price and 100 million shares has a market cap of $4 billion. This is what we're going to use and add this to net debt to get the company's enterprise value or total market value. So the total capitalization or enterprise value is equal to the sum of net debt and the equity market capitalization. To arrive at the net debt weighting, we divide the net debt weighting into the total capitalization. To arrive at the equity weighting, we divide the equity market cap, again, market, not book, into the total capitalization. So we get our net debt ratio, our equity ratio, and then we multiply both ratios by the after-tax cost of debt plus the equity cost of capital. So here, right, our enterprise value, or total cap is 7.5. The debt weighting is 0.47. The equity weighting is 0.53. These should always sum to 1. So here we're going to calculate this company's after-tax cost of capital. So our after-tax cost of debt, 1 minus the tax rate times 0.06. The net debt to total cap is 0.33. The equity weighting is 0.67. We multiply 0.33 times the after-tax cost of debt times the equity weighting times our cost of equity, and we get 6.8%. This one we don't need to do. So implications for this formula, right? Debt is cheaper. Actually, before we do this, how do I do this using my model? So I published this today as well. And this is how I like to have we'll be doing return on invested capital next week. So I would, again, if you're going to be doing this and turning it in, find your stated beta, assume a 4% risk-free rate and an R sub m of 8. You plug these in, and this is for Kimberly-Clark. You get a 5.76 equity cost of capital. Again, Kimberly-Clark, it's like watching paint dry, right? Buying diapers is not economically sensitive, right? Buying tissue paper, it doesn't really move that much. This is reflected in a very low beta, and as a result, right, its cost of equity is fairly low. We take the tax rate from 2023 times our debt cost of capital, 1 minus t times this, we get 4.23. Our equity capital is 5.76. Then we take our net debt from our balance sheet, right? Short-term debt plus long-term debt less cash and short-term investments. We multiply the shares outstanding times the stock price. Here's our enterprise value. Then we get the net debt and the equity weighting. And then we multiply these across, and we get our our cost of capital was 5.6% in this example. Okay? So here we can integrate, right, our model, income statement, right, balance sheet, etc., into calculating the cost of capital. This will feed our DCF, which we'll get to in a couple of weeks. Now, it's interesting. What do you do with a company like Meta, right? Meta, so because it's advertising based, I'm assuming, right, its beta is greater than 1, right? So their business model is more economically sensitive than the S&P, than the market, right? Their revenues are driven by advertising, which is economically sensitive. The beta is 1.29. Its cost of capital is 9.2%. Let's just say if they had debt, the yield to maturity is 5.5%. So Meta has net debt that's negative, meaning it has more cash than debt on its balance sheet. In this instance, because there's really no debt outstanding, its cost of debt is 0, and the cost of capital is equal to the cost of equity capital. So in case you run against this, this is how I handle it. And again, this example is under today's lecture. So what are the overall implications? Debt is cheaper than equity. Equity is expensive. There's actually an incentive for management to issue debt to lower its cost of capital. You know, there are some constraints. I think you may have gone over these in core, right? You don't want to issue so much debt, right, that you introduce bankruptcy risk. So this is somewhat of a constraint on management. I would argue lowering, right, your WACC through debt is actually a bad thing. So as I think about, this is from a corporate finance perspective, if you're in a corporate finance department, you're probably much better off using the cost of equity as your hurdle rate and not the weighted average cost of capital, which includes debt. And the reason why this is that, if you have a higher hurdle rate, right, you're going to raise the overall, value of the firm by not accepting projects with lower returns. And it also reduces the potential for managements to issue debt to lower their costs of capital. Managements at many companies like to be busy, And so the more stuff they do and the more they're happy. And so I would argue for corporate finance purposes, the equity cost of capital should be the weighted average cost. We should not deal with debt. Right? And just finally, cost of capital, it does impose discipline on managers. Only pursue projects that have rates of return in excess of their cost of capital. Appropriate way to measure risk in a firm, compare the project return or your equity potential return to the cost of capital, and it's the appropriate discount rate. So we're going to, there's actually a bunch of theory on capital structure, which I may touch on next week as it relates to return on invested capital. But this is, the basics of how to calculate a weighted average cost of capital, both debt and equity. Today, post-2008 financial crisis, many companies have become very risk averse in how much debt that they have on their balance sheet. And I'd be willing to bet if you actually did a study today, most companies' capitalizations are very much equity driven and much less debt driven. I would probably guess today, if we look at the enterprise value, the total market value, 75% of it's probably equity and 25% of it is debt related. That was much higher pre-2008, but the financial crisis, many companies didn't survive because they had too much debt on their balance sheet. They had to refinance, and that was the end of them. This sent a chill through CEO, CFO, board of directors, and as a result today, most companies are much more equity financed than debt financed. All right, yes, Nicholas.
Professor, if you were interviewing someone and you had to ask one or two questions to test them on cost of capital, what is something you would ask?
Oh, that's a good, what would I ask about cost of capital? I would really get to if I was asking, how does the risk-free rate impact the overall cost of capital? That would be one question. How does a risk-free rate, because you all, and this kills me, right? You're taking your core final or midterm and they're asking you, pumping the numbers in the equation and you're getting the right answer. But I asked this question because I teach CAPM like second day of my equity and security, and no one can get the answer, which just drives a stake through my heart, right? So you know the math, and you can get the answer right on the midterm, but you have no idea. So rates are critical in determining the cost of capital. When rates are low, cost of capital declines. When rates are high, cost of capital increases. Again, in 2022, why did the stock market get killed? In a particular, high growth companies. Well, these high growth companies, their value is totally driven by the terminal value, because you got to go 10 years out to actually arrive at some profitability, because they're all losing money today, right? Well, with rates are low, that 10 years out, that terminal value with low rates is worth a lot more if all of a sudden you jack your cost of capital up by a couple hundred basis points, right? So that would be one question. And then really, what does beta really mean, right? Yes, it's a mathematical equation, right? It's a regression through a bunch of through a bunch of data points, but it really reflects how economically sensitive is this business. What is this? It's the market's perception of the economic sensitivity of the business, right? And if we really look what drives cost of capital, it's two things. It's the risk-free rate and then the market's perception of the riskiness of the business model, right? Higher the beta, the more economically sensitive the company's business is, to something else, right? So again, simple example, Coke has a beta of 0.6, American has a beta of 1.8. Tell me why that is, right? I would be willing to get half the students would not get that right. Okay, I will see you guys next week, ROIC. And like everything, this has been posted, as has a couple of spreadsheets. Oh, that's right. Joel is, don't go anywhere. All right, sit down. I'm going to beat you over the head with the baseball bat. Don't go anywhere. Thank you. Who here is not signed up? Oh, shit, what happened? Oh, I got to. Oh, no, we're going through the. Hopefully, this will work quickly. Yes. All right. Who here is not signed up for Joel Tillinghast? All right. Take a picture and register. You cannot leave the room unless you register. All right. Joel Tilling, I worked with him. I'm not going to say he was a good friend of mine, but we got along professionally. He is an amazing stock picker. This guy is friggin' brilliant. This is a true story. I first met him when I was working in another firm before I joined Fidelity, and we were a broker was taking us to the Reds. We had like amazing seats. First, we're like 3 rows back from the first baseline. I mean, like the first baseman was right there. It was insane. You could see everything. 3 rows back. I'm right at a business school. The broker's buying me beers like it's like, this is great business, right? What a job. And Joel Tillinghast got involved, was also invited. He's sitting next to me. He has this bag, this big canvas bag filled with 10Ks. So we're watching the baseball game. He's not drinking any beer, and he has his nose in a 10K. This is Joel Tillinghast. He is Warren Buffett to the 10th degree. But he is a brilliant, brilliant investor. And he is a unique perspective. Sometimes people like him tell you something, you'll hear something, it'll stick in your head. So I'm obviously not going to beat you over the head at the baseball bat if you don't go, but it's rare to hear someone this intelligent. He has crushed both the market and the Russell over time, over 30 years. So he is well worth your time to go see. So if you haven't registered, please do. Now you can go.